Welcome to Retirement Millionaire Daily's weekly update, where we answer questions from readers like you. Recently, we've gotten a few questions about the recent Fed market decision. Now, with me today is senior analyst Matt Weinshank to help explain some of the questions our readers are having. Matt, can you tell us exactly what happened yesterday?
Sure. So the Federal Reserve announced that they were going to start trimming their quantitative easing bond holdings that they've amassed over the years, and they also signaled that there might be an interest rate rise in December.
In December?
Yes.
Okay, so what does that mean for our portfolios? Can we expect to see stock prices change, bond prices change?
Sure. So the big news is the trimming of the bond holdings. They're going to start selling off about $10 billion in bonds per month, and they collected these bonds to get more money out into the system and to push interest rates lower to improve the economy. But $10 billion is really just a drop in the bucket of what they hold and the size of the bond markets. So it's not going to have a big change on interest rates, certainly in the short term. We're still going to be in the era of cheap money, but what this really says is that the Federal Reserve finally thinks the economy is healthy enough to stand on its own. So that healthy economy is good for stocks, it's good for bonds. That's really the signal to take away from this. So we're still optimistic across, most asset classes.
Great. So if December, that's when it's going to change, you mean we can keep buying up until then and past that? What do you see for...
I think that at this stage, you don't really have to trade around Federal Reserve announcements. Unless you're a day trader, you should keep your same asset allocation and keep plowing ahead as usual.
Fantastic. All right. Thanks so much, Matt. Hope this helps. If you have any more questions or concerns, send them to our feedback line. Don't forget to like, share, and subscribe, and we'll see you next week.